Hi everyone, our video for today comes with the title April Crush, is it really happening? Our video is out to help you in making a successful investment decision. As you may know, it's designed to be short and simple and suitable for even audience with limited knowledge about financial markets. If you find the contents helpful, please share it, like it, and subscribe for the channel for more videos in the future. As you may have noticed, the YouTube is full of videos that are expecting an event which is unknown at the moment to take place on April, and it will lead for a crash, a financial markets crash, and the only safe thing will be the US dollar. In this video, I'm putting my thoughts on this subject. My working theory in the past few months was simply ditch the US dollar and buy anything else, buy it on the dip, except for gold. I'm with the markets to rally, but there is some concerns that have appeared on the surface recently, which we do need to discuss, at least to be aware of it. We are going to discuss four warning signs. The first one is the increasing presence of the retail traders in the financial markets. The second concern is the rising yields, and the third concern is the strength of the US dollar, and the fourth is the Fed capacity to stay on control of its monetary policy. Before going through the risk factors, please note that a drop in any price, any asset's price of 5% to 10% is defined as a pullback. And if the drop goes somewhere between 10% to 20%, that is defined as a correction. And if the drop in the value of that asset keeps going and it reaches behind the 20%, that is defined as a bear market. Moving on, we will start with the shoe shine boy indicator. You may have heard this before. It's a popular story being told over and over, and no one knows actually if it's true or no. However, back in the year 1929, and ahead of the Great Recession, Joe Kennedy claimed that he got the clue that it's the time or the proper time to get out of the market when he got an investment tip from a shoe shine boy. Uh, However, since then, this has been used as a metaphor when the presence of the retail traders increase significantly in the financial markets. In my opinion, times are different now, and the access for the financial information is way easier than in the back in the 1929. Also, technical analysis is no longer a secret, and people can learn it and trade. But it's still somehow a sign that we shouldn't neglect, especially if you combine this with the Wall Street bets actions on the GameStop stocks. Usually these things happens at the end of a bull run. Secondly is the rising yields, and when the yields are rising in an environment of a stable interest rates, this tells you that the bonds of the which the yields are rising are getting sold. However, bond market is the biggest of the markets. It's bigger than the equity or the crypto or the commodities. It's the biggest market out there. And hedge funds, many managers, they have some sort of a playbook that they sell usually the stocks when the yields are rising. Sure, they do have something. They are not doing this just blindly, because when the yields are rising, this tells you the inflation is increasing, and this tells you the interest rate, the real interest rate, which is the commercial banks using it for lending, is going higher and higher. The third concern is the strength in the US dollar, which is fueled by the weakness of the euro, and this weakness may still go on as you may recall, in the last summer, the euro rallied by the fact that the European countries were showing much more better response to coronavirus containment efforts than in the United States. But it's now the other way around. The US is reopening while the European countries are declaring shutdowns and lockdowns one after the other. And in case this goes on, we do have to expect that the US dollar is going to show some strength, at least in the foreseeable future. The fourth of the concerns is the Fed capacity to stay in control of its monetary policy. Simply, it is less than before or pre-pandemic levels. Interest rates are nearby zero, and the QE or the quantitative easing has been already implemented on heavy scale. Thus, I doubt that the Fed could really risk losing its appeal on the bond market, considering the huge debt of the United States. So maybe the Fed sometime soon could be forced to increase the interest rates. Now, as we talked about these concerns, that could lead for a market correction or a market collapse, which is due maybe April, May, June, or maybe later. God only knows. In conclusion, stocks may correct and may correct in a severe way, but it would just create a great buying opportunity. Simply, stocks are not in a bubble mode yet, but the US dollar is a bubble. However, on the last year, the US government printed more than 25% of the supply of the total supply of the US dollar, just only on the last year. So if you will assume in a very simple calculation that Nasdaq rallied 25% from the pre-pandemic levels up to 14,000 or nearby 14,000, made 25%, it did not reflect even the real growth of the stocks. So simply, I do believe that stocks are not in a bubble yet, and but being cautious is not something harmful if you can squeeze down your long positions in the stocks market or the crypto market or the commodities, whatever the market is, because if a crash happens, there is nothing would be as safe as the cash. This powder, this cash, you could use into buying in when a great opportunity present itself. That's all for our video for today. Thank you guys for watching. Please share, like, and subscribe, and I'll see you in a few days in another video.